Welcome, Jeremy and Garrick. Thanks so much for joining us. The value of all stablecoins and issuance recently surpassed the $10 billion mark and trebled since the start of the year. We started out with fiat-backed tokens to support crypto trading and evolved to payments to trading of non-digital assets, and now we're talking about the digital dollar in the Senate yesterday. What has accounted for such rapid growth? Jeremy?
Well, it's been really interesting. We've seen with US dollar coin, USDC, since basically correlated pretty closely to the outbreak of the COVID pandemic, a pretty dramatic growth in every major metric around the center USDC stablecoin. So we've seen the amount in circulation grow by well over 100%. It's just a hair shy of 1 billion USDC in circulation. We've seen the amount of issuance and redemption overall, so people kind of using it as a rail, coming in and out, growing very, very fast. And then, other metrics like the number of wallets using it, on-chain transaction volumes, all these have continued to move pretty steadily. And it correlates, the correlation to COVID, I think, is striking in a few ways. So I think the first is we obviously saw with the outbreak, the sort of global economic crisis unfolding as well, and a rapid shift into dollars as a safe haven asset, a historical safe haven asset. And digital dollars are in some ways also they're also a safe haven asset, although they have some attributes that I think make them particularly attractive in global markets. When you think about a dollar today, if you have a dollar in a commercial bank account, that's a fractional reserve dollar. So it's a dollar that is, being lent out over and over. And so if you have questions about, say, the potential for solvency risk in households or firms, and in turn, what that might mean for solvency risk of financial institutions, the fractional reserve money is challenging. We've seen that in multiple crises. So we've sort of staved off a financial crisis for now, but as this unfolds, there is that risk. And I think it's very easy when we think about dollars to think about, oh, well, I've got Bank of America or I've got a Chase account. That's the United States. Dollarization is a global theme. It's about Latin America, Africa, South Asia, other parts of the world where they do not have the firepower of the Fed. They do not have the fiscal means to counteract the incredible destruction that the pandemic's having on their economies. And so we're seeing this demand for digital dollars grow. Digital dollars also have the benefit of being internet dollars. They travel at the speed of the internet. They can be transferred with relative ease, very inexpensively. And so I think there's, the utility value is high. And so that's one factor. The other is obviously the digital asset markets, which is, of course, a place where there's a lot of trading activity. We've seen sharpening volatility, sharpening trading action, and that drives demand for stablecoins. So we've seen that clearly correlated. And then finally, we've seen sort of this anomaly, perhaps, of DeFi-induced demand for stablecoins as people participate in the incentive schemes around these new DeFi protocols. That's driven hundreds of millions of dollars, literally hundreds of millions of USDC into Compound, just as a recent example. So yeah. Lots of factors.
Yield farming. So Garrick, you just published the first part of a 3-part paper on the digital dollar where you talk about the change in sentiment from central banks towards the idea has been very rapid. And we know that Libra was a starting gun and has been fast-tracked by COVID. But you also say that most people don't understand the difference between commercial and central banks. Can you talk a little bit more about that and your article?
Yes, thank you. Commercial bank money and central bank money has been a challenging topic for, I think, many people to understand for as long as I've been teaching. I mentioned, that I bring this up regularly over the last 10 years in lectures to executives in financial services companies, even who understand that the coins in our pockets, the banknotes in our pockets, are minted by central banks and governments, but don't appreciate how much of the total money supply is actually manufactured by commercial banks when they make loans. That is where the vast majority of money comes from. And so there's a real economic education gap, around the topic of money, which has, been a huge challenge for helping people to understand crypto assets like Bitcoin through the years, but also is going to be a huge challenge for engaging the broader general public on this question of a digital dollar, kind of an expansion of central bank digital currency. We already have central bank digital currency. It's just not widely available to people like me in the streets. Commercial banks and foreign governments get to hold accounts at the New York Fed, but I can't walk in and set up my own personal bank account at the New York Fed like maybe I could with a digital dollar. And that's, I think, a huge issue. Like, how well understood is this issue, not just across the general public, but as we've seen, and Jeremy can attest to this, I know he's gone in front of Congress, we've got a technology challenge as well, in explaining how some of these, blockchain technologies and programmability of currency and so on and so forth, the various benefits you would gain with a digital dollar. What are those benefits? How is that different from things like FedNow, the faster payment system the Fed's going to be rolling out at some point? So there's a huge education challenge, and really, I think it all starts with understanding that there's big differences between central bank currency, which you can think of from a retail perspective as the coins and banknotes in your pocket, and commercial bank money, which is when you look up at your account balance in online banking, what's the bank showing you have. That's commercial bank money. That is bank manufactured money that is lent into existence, and it has different properties around settlement finality and other characteristics than central bank money. So we've got a lot of work to do on the education side, for sure.
I'd like to think. I want to just comment on something you said, Garrick, which is, I'm a big believer that sort of private sector actors who innovate with software are going to create products and services and experiences that hundreds of millions and billions of people fall in love with. And that's actually just going to be the education. And what it really comes down to is there something I can do with the phone in my pocket that's 10 times more powerful than what I can do with a piece of paper in my pocket or with my Bank of America app or whatever it is. And my belief is that for a very large percentage of our population, including in every developing market as well, they're accustomed to the power of WhatsApp. They're accustomed to the power of instant global communication, content sharing, transacting. And to them, the fact that money doesn't work the way the rest of the internet works is just it's actually confounding. It's kind of like, well, of course it should just work that way, and I should be able to do this. And I think people will look at things like digital cash the same way they think about physical cash, which is, hey, I have this digital cash. This isn't like in some bank. This is actually something I possess and I control. And that's a very, very empowering thing, and especially in emerging markets where the debasement of currency is a real challenge and is likely to accelerate significantly in many markets around the world. I mean, arguably, we're debasing it here in the U.S. even. That kind of model people will intuitively grasp. And you're already seeing that. So things like USDC is we're seeing surging demand in Latin America. It's because people have figured out that they can have a digital wallet that's a lot better than trying to, hide Benjamins. And that's important. The utility value is apparent to people. And I think that's ultimately how we overcome some of the education hurdles.
Yeah, I just briefly, I'll say 100% agree with Jeremy. I mean, I don't think most people understand the simple mail transfer protocol, SMTP, but billions of people use email. So to your point, Jeremy, exactly. If it's made easy enough for people to use and it does something better, faster, cheaper, how well they understand what's going on under the hood is not necessarily a huge barrier to adoption, but I do think it would be helpful for people to have a better understanding of how money works, for understanding things like the digital dollar, Bitcoin, et cetera.
Yeah.
So given the speed of the digital dollar now, do you think that the government would work with private sectors or existing stablecoin technology to accelerate that process?
I think so. I mean, and it really depends on where you are around the world. There are a couple of key things to state on this. So the first is that the largest scale global regulatory response to this problem space is specifically to come up with a set of policy frameworks for working with the private sector. The G20, which is the collection of the 20 most largest economies in the world, the financial ministers and key regulators of the G20, the Financial Stability Board, have been hard at work for the last year, building a set of policy guidelines for G20 members for how to regulate global stablecoin arrangements. They're not sitting around saying, how do we create a digital currency? They're saying the private sector is here, the private sector is innovating, and we just want to make sure that when these products and services are brought to market at scale, as they are beginning to, and certainly in 2021, we expect to see these reach hundreds of millions, if not billions of people, make sure that they're handled safely. And so I think that's exactly what's happening, is the public sector is very actively working with the private sector, including the US government, including international governments around the world, to figure out how to make this work. And so, the dominant theme today is public-private coordination, and that's happening through the FSB. And I'm very encouraged by that. And then I would just say, even just more domestically in the United States, the U.S. Treasury and the key banking regulator of the U.S. Treasury, the OCC, that oversees national bank and national bank charters, Brian Brooks. I had the pleasure of working closely with Brian on establishing Center Consortium, on establishing USDC. He's now at the OCC and is I think quite constructive about how the Treasury Department can work with the crypto industry, how it can work with leading fintechs that are innovating in this space. He's published extensively publicly on the private sector leading in the digital dollar space. And so I think you had that there. And as we saw yesterday, I mean, there's certainly more willingness to hear about this, at least in Senate committees.
Speaking of the Center Consortium, you recently switched from Ethereum to Algorand, focus on interoperability and enterprise readiness for institutional adoption. Was that, and you had a number of recent announcements. You also announced a partnership with the bank Frick in Europe, and you had the Circle business accounts, which has grown 700% over the past few weeks, with more than 2/3 of the businesses coming from outside crypto. So all of these announcements, tell us more.
Well, so very distinct items. Maybe I'll focus in on USDC. So just to be clear, Center Consortium, which is a member governed consortium that Circle and Coinbase established in 2018, sets standards for the technology standards for the USDC protocol, the asset reserve standards, the audit standards, compliance standards. So it's the network policies. So it's a policy-making organization and a standard-setting organization for fiat-backed stablecoins. And US dollar coin is the first fiat-backed stablecoin and associated protocol that Center Consortium has put forward. So that's what Center Consortium is. One of the really key goals for Center Consortium is to ensure that your digital money can be cross-platform. And what do I mean by that? And by the way, just to be clear, we did not switch from Ethereum to Algorand. So I'll clarify that in answering this. The really critical thing is that we want our digital money to be cross-platform. Just like we would not like it if a photo we took on our iPhone was only available to share with people who had iPhoto. We want our digital content to be portable. We want it to be work across operating systems, whether it's a desktop Windows machine or an Android device or my embedded software on my refrigerator. Whatever it is, you need these content standards and data standards to work on lots of different operating systems. Blockchains are like operating systems. In particular, these sort of second and third generation operating systems. They provide an environment to store data, to run code, to support transactions. And there's a lot of competition in this particular type of internet operating system. Ethereum itself brought competition to Bitcoin. There's now intense competition for sort of the next generation chains. And one of the things that's really a known issue is that Ethereum today has some constraints. It has some constraints in terms of how many transactions per second it can perform. It has some constraints on the sort of scalability. And there's a third generation, sort of Ethereum 2, which I consider to be like a third generation blockchain, is very, very promising in terms of how it will solve some of the scalability issues over the long run. But in the interim, there is a lot of innovation, and we want to make sure that USDC can be supported on multiple chains and in an interoperable way. So if for example, Algorand, which is a newer chain, is very much purpose-built for financial industry applications. It's built for higher volume, so 400 to 1,000 transactions per second. It has built-in features that a regulated financial institution that wants to build on-chain applications would find compelling. So there's a set of use cases in the finance industry which would be more challenging to do on Ethereum, but would still want to be built on public infrastructure. And that's where something like supporting Algorand comes in. That is not going to be the last chain that Center Consortium has some degree of support for. And again, I think, when we use Spotify, we use it because it works on any operating system or device. We don't use it because it only works on, say, our Apple device. And I think our digital money is the same thing. We want to make sure that it works openly, interoperably, and cross-platform.
Great. And what about Frick?
Yeah. So the interesting thing about Bank Frick, Bank Frick is a kind of forward-leaning neobank that was sort of built out of the digital asset markets. The interesting thing is we don't actually have any specific partnership with Bank Frick. They're just adopting USDC as an open standard. And so this again kind of speaks to the model. USDC is just it exists as a smart contract on the public internet. Any developer in any firm can integrate it and support it. And you can think of it as like a rail that you can just connect to, and then you have support for it. So what we've seen literally over the past 6 months is the number of applications, financial institutions, third parties, et cetera, that are supporting that protocol has grown enormously. So there's probably 400 to 500 companies now that have integrated it. And it's really neat because each week it's like, oh, a bank is now using it as a rail. So that's the power of sort of standards that people can connect to and build on top of.
Garrick, I want to talk more about regulatory hurdles that might remain and the travel rule, FATF, that just went into effect this month, where sender and recipients need to be identified. How do you think stablecoins will be complying with this?
Yeah, so regulation. Jeremy, have we talked about regulation through the years? It never comes up, does it? Yeah. So I guess, let me step back from anything specific and just say, I think regulators, have been criticized through the years for various things, perhaps rightfully so in some cases. I think oftentimes they're some of the more unsung heroes in the story of cryptocurrency. I think there's been a lot of things that have been done well in certain jurisdictions in particular. But all this is still evolving. And the thing with regulation, like the travel rule, is, look, as cryptocurrency, and I've said this for years, as it grows in use and becomes more important, more integrated with the traditional financial system as we're seeing, it's inevitable we're going to see it more regulated in some way, shape, or form. And I think designing regulations that allow innovation, of course, to continue to foster and occur, but also safeguard, financial stability and consumers and so on is obviously very important. So, things like the travel rule, I think the positive way of looking at it is that, this is a way in which regulators are comfortable with crypto assets continuing to play in this space. You still hear people like Jim Rogers just last week, co-founder with George Soros of the Quantum Fund, expressing this view that, look, if cryptocurrencies ever get too big, regulators will simply eliminate them. And I think things like the travel rule, the fact that we have the Chicago's futures markets, the fact that we have an evolving body of regulations that's allowing cryptocurrency space to play and grow, is really the counter argument to that view expressed by Rogers, which is shared, I know, by other institutional investors who are kind of sitting on the sidelines because they think the end game for crypto is that it simply gets squashed if it ever goes beyond, it's still relatively small, tens of millions of users. I don't agree with that, obviously. And so I think these kinds of rules are necessary. Of course, they're going to impact negatively some companies. We've seen some firms shut down in the Netherlands and elsewhere. Business models have to adjust, but that's just part of playing the game, is my view.
Do you think stablecoins will surpass the crypto market cap in a few years?
The flippening. So, I think, Jeremy was very, smart to put USDC on Ethereum initially. I think a big part of the story with Tether's growth, which has powered kind of growth of stablecoins along with USDC and heck, even Gemini dollar. The Winklevosses have got pretty thick skin, so I don't mind giving them a little a little toughness here. But that thing was kind of tailing down and dying, and it's kind of I think with DeFi and lending kind of started to perk up a bit. I think being on top of Ethereum and Algorand and these other platforms that enable faster, cheaper transactions, combined with their stability, make them very compelling for a lot of use cases where something like Bitcoin, for example, is just too volatile. If you're in Venezuela, on the economic margins, paycheck or day to day, you're arguably much better off holding something like a digital dollar than you are something like Bitcoin, which can drop 50% in value like we saw in March. So I think stablecoins do have a huge role to play, and I'm going to expect that they're going to continue to grow. And they, I think more than Bitcoin, honestly, have been a big part of the story of why central banks have kind of reversed gears and said, we need to start looking more seriously at our own digital currencies.
And do you think that even though we have a zero interest rate environment, so stablecoins aren't throwing off as much fees, right?
Well, Jeremy mentioned earlier Compound and some of these, borrowing and lending protocols and platforms that have emerged really in the last 12 months, offering, sometimes double-digit interest, at least, more than you're getting at your U.S. bank account or European bank account, where we're seeing negative rates more and more. I think that's really attractive. The ability to earn interest at a reasonable level is a huge use case for many, many people. How big that can grow, I think, is one of the questions I have. How much capacity is there to continue to offer 4, 5, 6, 7, 8% interest rates annually on stablecoins as more and more people start using these products is a big open question. But right now it's a great deal. There's no such thing as a risk-free lunch, right? There's certainly things people need to look at, but if you are open to the risk of using, smart contract protocols, lending protocols, or centralized platforms to earn interest on stablecoins, they offer a real alternative to traditional bank accounts.
And your view on programmatic stablecoins like DAI?
Yeah,
Jeremy, you wanna jump in on that?
Well, I think I don't think of DAI as a programmatic stablecoin. I think of Maker as a margin lending facility. So effectively, it is a decentralized margin lending facility. Its biggest competition is Compound. Effectively, what you're doing is you're depositing and locking up crypto assets, and you're getting issued a token that is pegged at $1, but effectively you're borrowing dollars against collateral that you post. So I think that's really maybe more how to think about it. But I mean, similarly, you have the ability to lock up different forms of collateral in compound and borrow dollars as well. So increasingly, these are different takes on decentralized credit and lending markets that are decentralized, and I think fascinating. I think we're in the very early stages of their development. There's lots of analogies and metaphors and so on that people can use, but I like to harken back to, when eBay came out and people were selling Beanie Babies, and people were like, who's going to go on these peer-to-peer marketplaces and sell things to each other, and that's never going to work for the kinds of commerce that we have, and those peer-to-peer markets, which is really what eBay was. It was a centralized platform, obviously, but those peer-to-peer markets were astounding, and Craigslist or what have you, all these different fascinating examples. Peer-to-peer global decentralized financial credit markets has the potential to be quite enormous. And maybe to answer one other question that you had asked Garrett as well, which is, market cap flipping, that kind of thing. I mean, our view is that digital currencies that are fully reserved against the largest reserve currencies in the world will be in the trillions in issuance over time, because they'll be used in an enormous range of applications, not just payments applications, commerce applications, and financial applications. If I'm denominating a digital bond as a municipality, and I'm doing that on a public blockchain, and I need to collateralize that or have paid in and out with it, with real value, a stablecoin will be a way that you will do that. And so you'll see more and more digital securities that are denominated in stablecoins, and obviously that will grow the total amount that is in circulation pretty significantly over time.
Why haven't Euro stablecoins had much uptake?
I mean, my view on this is that the early adopter phase of stablecoins, which I would say, to use a quote from a discussion with Larry Summers last week, we're at the end of the beginning in terms of the story here. And the beginning of the stablecoin story was really about this hedging and arbitrage use case in what I call the crypto capital markets, or the digital asset markets. And it really was born out of that. It was born out of necessity. And that was sort of Tether and its core heritage. What I like to think of as second generation stablecoins like USDC, were also bootstrapped into that marketplace. So they were bootstrapped into the trading and exchange marketplace, but with an idea of being much broader in their utility, with the idea that these were going to ultimately be for payments and settlement and a broad array of commerce and financial applications way beyond trading. We're just at that kind of point where we're seeing that start to tip. And so that's very, very exciting. But that, I think, very much explains why Euro stablecoins haven't had much traction. It's because in the digital asset markets, all financial assets in the crypto space they're priced in dollars. Dollars are the quote currency. Dollars are the liquidity mechanism. And so you as a trading pair, as something that you're going to hold and trade with, dollar is the preferred instrument. And that's the same thing in financial markets all over the world. There are obviously pound sterling quoted markets in traditional markets, but dollar quoting is sort of dominant, and that is the case in digital asset markets as well. I think as we move towards payments and commerce use cases, and I think it's noteworthy that the first additional stablecoins from the Libra on the Libra payment network, are rumored to be, euro and pound and so on. That's because when you're actually doing payments and you live in Europe and you take your salary in euro, or you're a business that's accepting payments from people on the internet, you want to receive those in the same currency that you go to the grocery store and buy goods with, or that you pay your taxes with, or what have you. And so those become a lot more important when you get out of the capital markets use cases and into the payments and commerce use cases. And so I think those stablecoins will start to really grow. And that's in our roadmap as well, is to see reserve currency stablecoins beyond the dollar as these other use cases start to light up.
Garrick, any comment on that?
No, I agree with Jeremy. And, I think network effects are obviously a huge factor in currency adoption. The dollar has a huge network effect, and US dollar-backed stablecoins have already achieved a pretty significant network effect. And so, it wouldn't surprise me if, I agree. I think we're going to see Euro stablecoins and so on. There are some already. But because the dollar has kind of gotten out of the gates early, if it still maintains outsized market share relative to Euro backed stablecoins, they kind of, if you're a trader, you just want something that's, allowing you to take risk off and get into a stable asset. They sort of kind of solve a similar challenge. And so why not go with the most, widely accepted, deepest liquid stablecoin? And so the head start the US dollar stablecoins have had may be, something that's difficult to kind of leapfrog or catch up to.
Great. Well, thank you both for being here today. That was very informative. We look forward to keeping in touch and seeing how the market grows.